Today, Australian property in the crosshairs. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. The ABS released the latest housing finance figures today, and the OECD issued a warning that not all is well in our housing sector. So today we look at what they said. And by the way, if you value the content we produce, please do consider joining our Patreon program. Here is a link. Or make a donation via PayPal. Again, here is the link, so that you can support our ability to continue to make great content. The ABS released their housing lending data to the end of October 2018. The media will fixate on the 2.6% rise in seasonally adjusted terms, and some will claim that this marks the turnaround in mortgage lending. However, it is worth saying that the seasonally adjusted series moves around significantly, and it does not always take into account the much longer processing and settlement time that we're now seeing as banks continue to tighten their underwriting criteria. Average loan settlement times have blown out considerably. So, we will continue to look at the trend series, which seeks to iron out the humps and bumps, and tends to be more reliable in terms of the overall trajectory. But before we go there, let's look at the original data series. So first, to the stock of home loans held by the banks. Owner-occupied loans rose 0.4% in the month, or $4.8 billion, to stand at $1.129 trillion. Investment loans were flat in the month, standing at $565.5 billion. And so total home lending grew at 0.3% to $1.695 trillion. And investor loans comprised 33.4% of all loans outstanding, compared with 39% in May 2015. The original first-time buyer data show that there was a rise of 15.7% compared with the previous month to 10,137 loans approved, which offset the significant fall last month and was caused by the same longer loan processing times and the incentives which are still there in the system to try and encourage first-time buyers into the market. That meant that 18.1% of all loans were for first-time buyers, still well below the 21% we saw in December 2011 or the 30.6% we saw back in 2009. More loans were fixed rate this month, a reflection of the cheaper refinancing details on offer. And the DFA first-time buyer tracker, which includes first-time buyers going direct to the investment market, continues to fall. So now to the trend flow series. Total flows were down 1% to $29.85 billion, and within that, refinances fell 0.1% to $6.3 billion. Owner-occupied loans fell 1.5% to $13.69 billion, and investment loans fell 1% to $9.84 billion. Investor flows comprise 41.82% of new flows, excluding refinances, and refinances made up 21.1% of flows, the highest since June 2016. Now, looking at the moving parts, lending flows for owner-occupied secure construction fell 1.1% to $1.8 billion. Purchase flows of new dwellings was down 2.5% to $1.04 billion, and the purchase for owner-occupation of established buildings fell 1.4% to $10.77 billion. Refinance flows fell just 0.1% to $6.31 billion, while investment-related construction fell 3.1% to $0.9 billion. Purchase for individual investors fell 0.7% to $8.19 trillion, and investment purchases by other entities, for example, superannuation funds, was down 0.21% to $0.74 billion. So, to conclude from all this, there is nothing here to indicate a recovery in home lending, and in some categories the volumes continue to shrink consistently. In fact, we will not get a good read until, let's say, February data next year, as the next couple of months are always wobbly thanks to the summer holidays. And What we do know is that auction clearance rates are languishing and more property remains on sale for longer. So we think loan volumes will continue to weaken. And so now to the OECD report, which released their economic survey for Australia. The report started off well enough, parroting the same as the government and the RBA in terms of low unemployment, 27 years of growth and robust output. Life is good, they say, with high levels of well-being, including health and education. But then it gets a bit darker, referring to globalization and automation, which, while overall positive, they say, have disrupted the lives of several groups of people. Certain groups are vulnerable with low labour force participation and high risks of poverty. The substantial gaps between Indigenous Australians and the rest of the population are narrowing too slowly, they say. And then they go on to say that Australia has made little progress in reducing its environmental footprint, in large part because frequent changes in core climate change instruments have created uncertainty for emitters, which has also discouraged energy sector investment. Biodiversity, they say, is also a core environmental issue for Australia. The country is host for around 10% of the world's biodiversity, with many fragile situations. But then they turn to the housing market and say straight out, the housing market poses economic risks. Australia's housing market is a source of vulnerabilities due to elevated prices and related household debt. House prices have fallen, although only gradually since last year, they say. And a direct hit to the financial sector from a wave of mortgage defaults is unlikely. However, if house prices collapse, consumer spending could suffer via negative impact on wealth, including from exposures to bank shares, which would encourage deleveraging. Together with reduced housing-related expenditures, this will put pressure on the whole economy. And they say that the current trajectory would suggest a soft landing, but risks of a hard landing remain. And financial supervisors and bank regulators should be prepared in the event of a hard landing in the housing market. And they should also continue to address shortcomings in the financial sector identified in recent inquiries, particularly competition, misconduct and fraud. And the OECD recommends that in the absence of a downturn, Australia should gradually remove monetary accommodation through a policy rate increase. And regulators need to prepare contingency plans for a possible significant correction in the housing market, including a loss-absorbing regime, including bail-in provisions in the case of financial institution insolvency. So, all very much in line with the discussions on the DFA channel, and of course that we have been highlighting the significant issues, particularly around bail-in. And they say that rapid population growth is supporting Australia's economic growth, but concentration in metropolitan areas is straining infrastructures and fueling traffic congestion, noise and air pollution. And in the absence of negative shocks, policy rates should start to rise soon. Monetary conditions remain very accommodative, with a risk of imbalances accumulating further if the low interest rate environment persists. And in the absence of a downturn, a gradual tightening should start as inflation edges up and wages growth gains momentum. And they turn to government spending, suggesting that budget repair needs to continue. And they talk about tax reform and specifically the opportunity to lift the GST, which is at the lower end of international benchmarks. They suggest a lift in the rate would assist. So all of this is the clearest message yet from the OECD that Australia needs to change its thinking on the debt bomb and risks in the housing sector. And they offer a range of broader policy options which we should take very seriously. In the absence of leadership locally, the OECD has made a good stab at setting an agenda, and I think it's worth really taking seriously. As always, if you like what you've seen here today, please share and like the post and add a comment or question. I read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now by hitting the subscribe bell. And if you have already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North, the Principal Analyst at Digital Finance Analytics. Many thanks for watching, and I'll see you next time.